The global financial system is undergoing a rapid digital transformation. Around the world, money is becoming increasingly digital, transactions are faster, cross-border payments more seamless, and private fintech firms are playing an important role in managing financial flows. On one side, we have central bank digital currencies, aka CBDCs, the digital form of a country's fiat currency, sometimes called a digital dollar. They are state issue backed by the central bank, essentially digital cash or a direct liability of the state. On the other side, we have stable coins, privately issued digital tokens typically pegged to fiat currencies such as the US dollar and backed by reserves. Together, these two forms of digital money, both public and private, are reshaping how money moves globally. Let's dive into CBDCs first. We have included this world heat map to show you which countries are currently exploring them. As of mid-2025, over 137 countries representing nearly 98% of global GDP are exploring or developing CBDCs. Most central banks, including the US, are researching tokenized or blockchain-based distributed ledger technology to support these systems. However, not all are choosing public blockchains. Some prefer centralized database models for better control, performance, and privacy. What's clear is that no major economy wants to fall behind in this digital currency race. Now that we have seen how CBDCs are progressing around the world, let's turn our focus to the US and how a potential US CBDC could reshape its fintech landscape. A US CBDC could transform fintech in several ways. It could create new infrastructure for real-time programmer payments enabling faster and more automated transactions. It could drive innovations in digital wallets, cross-border payments, and embedded finance, and importantly, it will provide safe public digital money for modern financial application. However, CBDC could also introduce some challenges. It might reduce bank deposits, affecting credit availability and potentially altering how fintech firms partner with traditional banks. And until there's a clear regulatory framework, uncertainty would slow private innovation and investment in digital finance. So while a US CBDC presents some opportunities for modernization, we can see challenges that the financial sector must carefully navigate. In the US, the Fed began exploring CBDC in 2022 and we can see it through its paper money and payments, the US dollar, in the age of digital transformation. It has continued to research and pilot programs, but any launch will require congressional authorization and public support. In July 2025, the US House passed the Anti-CBDC Surveillance State Act, which seeks to prevent the Fed from issuing a CBDC amid privacy and government overreach concerns. Although this limits the prospect of a US CBDC, the country is now actively exploring stablecoins as an alternative path for digital currency innovation. The Genius Act, also passed in July 2025, sets clear standards for how stablecoins must be backed, disclosed, and managed. And in line with this, several Trump-era initiatives have encouraged financial institutions to pilot or adopt stablecoin-based payment solutions.
Hello, I will be speaking about stablecoins in the next few slides. Stablecoins are digital currencies that are privately issued and backed by reserves. They are designed to keep its value stable according to the currency it is pegged to, for example, the USD or SGD. There are two main types of stablecoins. The first type is backed by reserve assets, such as fiat, gold, and treasury bills. The second type is backed using algorithms such as smart contracts on blockchains to automatically adjust token supply and demand through algorithms. Some of the examples of stablecoins are as shown. USDT and USDC are backed by fiat and fully reserved assets, while PAXG and XAUT are backed by gold. UST, on the other hand, has an algorithm model to maintain stability. Stablecoins are very useful for payments, savings, and trading in digital finance. Stablecoins have been trending up since inception. The graph on the left shows the size of stablecoins in the crypto asset ecosystem from 2020 to 2025. It is shown that the market cap of USDT and USDC grew about 200 to 300% since year 2021. The chart in the middle shows the percent of stablecoin flows by country. US and Singapore are clear leaders, amounting to almost 40% of stablecoin flows in the world. Besides that, the chart on the right shows stablecoin activity by type. There is a clear trend of uptick in B2B card and B2C stablecoin activities, which shows that businesses and institutions are embracing stablecoins. All these data points show that stablecoins are increasing in demand and well accepted in the US. Next, we will explore how stablecoins impact the fintech ecosystem. Firstly, stablecoins encourage payment innovation because stablecoins can be transacted almost instantly and securely with low transaction costs. The transactions are borderless with the support of internet connectivity. Next, stablecoins cause banking transformation by offering banks a cost-free deposit source, potentially reshaping their revenue models and liquidity strategies. Stablecoins also promote financial inclusion by giving the unbanked and underbanked populations access to digital finance. Due to the reduced transaction costs and faster cross-border payments, businesses and institutions are embracing stablecoins and adopting quickly. This resulted in the increase in trend for B2B and B2C activities as discussed in the previous slide. Lastly, stablecoins are becoming the backbone of programmable finance by enabling smart contracts integration for automated transactions, such as subscription billing, automated payroll, and others. The key factors contributing to stablecoins adoption will be discussed in this slide. Due to the technological advancements in the blockchain infrastructure, stablecoins can be implemented. Most stablecoins have permissioned public ledger type, allowing the public to view all on-chain transactions, but the governance and control are by approved members of the organizations. Recently, the US came up with the first comprehensive federal regulatory framework for stablecoins called the Genius Act. This is to ensure that stablecoin issuers are regulated with reserve requirements and reporting transparency to prioritize consumer protection. The Genius Act also aims to strengthen the US dollar's reserve currency status and treasury's demand. Other than that, globalization brings about a high international transaction volume, which calls for lower transaction costs and instantaneous settlements, which can be realized by the use of stablecoins. Lastly, the growth in institutional adoption drives social confidence and trust to use the stablecoins ecosystem. The unbanked and underbanked populations can easily adopt stablecoins with smartphone and internet adoption.
As presented earlier by Yiqing and Jipei, the US is exploring two main paths toward a digital dollar, through a central bank digital currency or CBDC, and through privately issued stablecoins. CBDCs issued by the Federal Reserve are still largely in the research stage due to political resistance under the Anti-CBDC Act. While they emphasize sovereign control and policy oversight, there is significant concerns around privacy and could potentially reduce bank deposits. Their technology is centralized and progress has been slow due to policy and governance constraints. In contrast, stablecoins like USDC are privately issued on blockchain networks using smart contracts. They are already widely adopted, driving fintech innovation, preserving the role of banks, and effectively serving as a digital dollar by proxy to extend US dollar influence globally. In short, while CBDCs remain politically constrained, stablecoins have moved ahead in real-world adoption and innovation. Looking at the benefits and risks of both models, CBDCs offer secure, direct access to central bank-backed money, faster settlements, and greater control over monetary policy. However, they come with major privacy and cybersecurity concerns and could slow innovation due to government oversight. Stablecoins, on the other hand, enable 24/7, low-cost global transactions and open participation across fintech and DeFi ecosystems. But they carry risks of hacking, smart contract vulnerabilities, and uncertain regulation as laws evolve. Overall, CBDCs promise control and stability, while stablecoins deliver speed and innovation. The challenge for the US is to strike a balance, combining centralized trust with private sector agility to shape the next phase of digital finance. Based on these developments, the US appears more likely to focus on regulated stablecoins rather than a formal CBDC. First, under the Genius Act, regulators can supervise stablecoin issuers and enforce compliance without triggering public backlash over government surveillance, avoiding the politically sensitive debate around a central bank-issued digital dollar. Second, this model preserves financial intermediation. Banks can issue or partner in stablecoin programs, maintaining their role in the financial system and preventing a large-scale deposit flight to non-bank entities. Third, it strengthens US global competitiveness, as dollar-backed stablecoins act as a digital dollar by proxy, extending the dollar's reach in cross-border payments and international trade. And finally, it encourages private innovation, enabling faster product cycles, fintech and AI integration, and technological advancement without heavy government intervention. In essence, stablecoins can achieve many of the same benefits as a CBDC, for instance, speed, programmability, and global reach, but with far less political and implementation risk. This slide highlights the main risks of stablecoins and how they can be mitigated. First, depegging hacks and regulatory gaps pose the biggest immediate threats, leading to price instability and loss of trust. This can be addressed by requiring 100% reserves in high-quality liquid assets like US Treasuries, conducting real-time audits, and maintaining insurance coverage against cyber or operational failures. Second, regulatory uncertainty remains a challenge. To mitigate this, issuers should engage early through sandboxes and frameworks such as Genius Act and form industry alliances to promote standardization and policy alignment. Third, monetary control risk, where large-scale issuance could disrupt stability, can be managed by setting issuance caps, enforcing reserve ratios, and running regular liquidity stress tests. Finally, smart contract vulnerabilities require continuous code audits, bug bounty programs, and strong fallback systems. With these safeguards, stablecoins can evolve responsibly, balancing innovation, systemic stability, and regulatory confidence.
Stablecoins are transforming fintechs. Companies must shift from traditional payment rails to blockchain-based system for faster, cheaper transaction. This opens new revenue streams like issuing of stablecoins, custody services, and programmable payments. However, compliance under the Genius Act adds complexity. It requires strict reserve and audits, which could drive market consolidation. Strategic partnership with banks are keys, as big players like PayPal and Stripe race to issue stablecoins. Adoption isn't easy. Fintechs need core system upgrades for blockchain connectivity and wallets, often within 12 to 8 months. Interoperability is another hurdle. Fragmented liquidity and lack of standard APIs push firms towards partnership and layer 2 solutions. Finally, risk management is critical. Smart contract flaw, liquidity mismatches, and reliance on blockchain uptime demand strong governance. Opportunity for fintechs are huge. Cross-border payment, stablecoin cut fees from 3 to 8% to under 1% with instant settlement. Global role pay, it enables fast salary payments to remote teams, reducing FX costs, and banking as a service. With clear regulation, fintechs can offer USD accounts and programmable money without traditional licenses. Beyond payments, stablecoin enable embedded finance and programmable payments like conditional transfer and automated settlements. They also allow instant B2B settlement, improving liquidity for merchants globally. And as the backbone for AI-driven financial agents, stablecoins support real-time programmable transactions and new models like autonomous treasury bots. The US is aging towards a digital dollar, but through stablecoins, not CBDC. Stablecoins combine regulatory oversight under the Genius Act with private sector innovation, avoiding political hurdles. They enable instant low-cost borderless payments and drive financial inclusion, and act as the backbone for programmable finance and AI-driven ecosystem. For fintech, this means opportunity in cross-border payments, embedded finance, and treasury management. However, success depends on strategic partnership, interoperability, and robust risk control. Finally, stablecoin offers speed, innovation, and global reach, acting as the digital dollar by proxy to strengthen US competitiveness without the political resistance of CBDCs. They open new revenue streams for fintech but require compliance with frameworks like the Genius Act and strong risk management. Ultimately, the future of digital finance will hinge on collaboration and resilience. Thank you.